I'd love to introduce Joe Valenti. He is the Director of Consumer Finance at the Center for American Progress. His work focuses on improving the ability of low and moderate income consumers to participate in the financial sector and to make the most of their resources. Prior to joining Center for American Progress, he was a Hamilton Fellow at the U.S. Treasury Department, and he's a fellow Columbia University alumnus, so I'm very happy to have him speak today, and please give a warm welcome to Joe Valenti.
Good morning. Thank you. Thanks, Teddy, for the very kind introduction and for inviting me to join in today's conversation. As Teddy noted, my name is Joe Valenti. I'm the Director of Consumer Finance at the Center for American Progress in D.C. And today I'm going to chat just briefly about some context in the auto lending market, the challenges that I see and how it's in some ways rather similar to what we see in some other lending markets, and a few thoughts on what we could do to make it function better. So first, to put vehicle lending and vehicle ownership into context. After a bank account, vehicles are the second most common asset that families hold. There are about 92% of households in the US that have a bank account, and vehicles are just right behind. About 86% have at least one vehicle, according to the Survey of Consumer Finances. And to put that in context, the home ownership rate currently is only about 64%. So people are much more likely to have a vehicle than to own a home these days. And for many Americans, a vehicle is essential. Outside of a few key metropolitan areas, families rely on their vehicle to get to work or school and go about their daily lives. More than 3/4 of Americans drive to work alone, according to the Census Bureau. And even in the New York metro area, which has the highest use of transit and other means in the country, about 56% of workers drive to work. So while we can and should invest in transit, I did take the metro this morning, and it worked out okay. And while we may be able to deal with the travel challenges that families face partly through new technology and ride-sharing, self-driving cars, for the time being, we are indeed auto-dependent. And we saw this even during the financial crisis in anecdotes of borrowers in foreclosure who would say, maybe half joking, you know, the bank could take the house. I can live in my car, but I can't drive my house to work. So we see the consequences when families don't have a reliable vehicle or they can't maintain one. We see the financial struggles that families face. You may have heard the recent numbers from the Federal Reserve that nearly half of all Americans would be unable to come up with $400 without borrowing or selling something. Now, $400, that can very easily be a car repair. And that's a car repair that can get between going to work or not going to work. But here's one case that, to me, really illustrates the essential nature of a reliable vehicle and some of the policy trade-offs that we need to think about. And this is a true story out of California. This was in the San Francisco Chronicle a few years ago. Melissa lives in California, and she decided to leave her abusive husband. And after doing so, she applied for temporary assistance to help make ends meet for her and her family. She owned an 8-year-old car that was still working pretty well for her. But at the time, it was worth more than $4,600. And at that point in California law, that was above the threshold for public assistance. Now, I know Teddy just talked about $5,000 now getting you a car with over 100,000 miles, a car that might break down. So picturing, what $4,600 will buy you in California, her application for public assistance was denied, which meant that she ultimately sold the car to help pay the rent. And by the time she was eligible for public assistance, she was far less off. Now, California has raised that threshold a little bit since then, but I often wonder, what would the answer be in her case? Would it be buying a vehicle under that $4,600 mark that may or may not be as reliable? Would she be able to obtain financing? What kinds of terms would be available to her? And as we see economic security slip away from so many Americans from decades of stagnant wages, rising costs, to an increase in the average car loan term, you mentioned car loans exceeding 72 months. I did see that Edmunds has reported the average car loan term now exceeds 5 years. Households are still seeking vehicles, as we see with the $1.1 trillion in outstanding car loans, according to the New York Fed, which is 30% higher than pre-crisis levels. And so far, that seems to be good for the economy, but for borrowers themselves, especially in subprime, the results remain mixed, and there are some questions. And I think it's in this case that we have a lot to learn from other types of lending. There's a report that we put out last year, I have some copies outside, called Lending for Success. And in this report, we looked at different forms of credit, whether it's a mortgage or a credit card to a car loan, even a payday loan. And we looked at lender practices over the life of a loan, not just what happens when a borrower is shopping around, but what happens after a loan is made and if a borrower faces hard times. And we identified a principle underlying quality lending products that I think may be useful as we think about subprime auto. And it's, are the borrowers and lenders' incentives aligned? In other words, does the lender succeed when the borrower succeeds by paying back the loan? Or does the lender succeed in spite of the borrower's failure in a scenario of heads I win, tails you lose? And from what I can tell of the market, it's not clear for auto loans, and especially subprime auto loans, that these incentives are always aligned. And as we saw, particularly in the foreclosure crisis, that can be a problem. Take the origination process. To what extent are lenders truly assessing the borrower's ability to repay? Are they actually underwriting the loan? Are they just going by the borrower's credit score, stated income? Are they focusing on an interest rate or just a monthly payment that can be tied to an extended loan term? Are they securing the best deal for the borrower, or are they using rate markups to conceal the actual cost of credit that a borrower could obtain? And are they properly valuing the collateral? A few years ago, the Los Angeles Times investigated buy here, pay here lots that were charging double what a vehicle was actually worth, so even far above 150% of LTV. So all too often, the answer to these questions is no. And this continues even after the car buyer leaves the lot. Are long loan terms leaving borrowers permanently underwater? And while no borrower expects to default out of the gate, what if he or she does fall behind? One of the most troubling developments in my mind today is the use of starter interrupt devices, sometimes known as kill switches, to disable a vehicle if a payment is late. These so-called remote repos may be really appealing to a dealer or to a lender as a collection device. But we have seen cases where they lead to invasions of privacy or the risk of physical harm. And this is a practice that would be unusual, I would think, for most other types of credit to be able to repossess so quickly and relatively effortlessly. And they reinforce what I mentioned at the beginning about how essential vehicles can be in people's lives. So essential that drastic measures may seem acceptable to some borrowers. And at that point, it behooves regulators and policymakers to be involved. So a few things that we should be considering. I think first we need some better data across the market. And the CFPB was criticized recently for its handling of the Ally Bank settlement on discriminatory dealer rate markups for a problem that, in my view, is fairly well documented. The Center for Responsible Lending has found that even borrowers with comparable credit scores who negotiate with the dealer at the same level still end up paying higher rates if they're African American or Latino. It's a stronger case than simply acknowledging that on the whole there can be a racial component, a very complicated one, that's connected with credit scoring. But the CFPB had to take this on indirectly, finding a way to identify minority borrowers, and the best mechanism they were able to use was relying on the dominant race or ethnicity within a zip code. And they took a fair amount of heat for that. But I would say, contrary to what some in Congress have argued, it wasn't capricious and wasn't a sign of poor intent. It was a sign of the limitations of data that we have in this market. And having a rich data set on individual car buyers, similar to what we've seen with the Home Mortgage Disclosure Act, or HMDA, would make it easier to figure out what's going on with fair lending. And if we want to have a debate on measuring and testing for fair lending, that's a debate worth having. I don't think a CFPB witch hunt meets that same standard. Second, we need better transparency for borrowers. Few would argue that the process today is transparent. Although in some cases, we may have gone from a paucity of information to a possible deluge. If you think of Carfax reports and true car ratings and car listings that are shared and start to look something like the multiple listing service for mortgages. But again, it comes down to a matter of incentives. It's hard to tell what the actual price of a vehicle may be, whether an internet price will hold true in person, how flexible a dealer will be. And it's easy to understand and appreciate the appeal of some places like CarMax that advertise that dealer haggling is not part of the equation. There's a lesson, I think, from Silicon Valley, whether we love or hate the innovations that are coming out, that there's a benefit to simply solving a consumer's problem easily. And third, perhaps the most controversial, is that we need supervision and regulation in this market, given the abuses we've seen not just at the beginning of a loan, but across the life of a loan. And there is a role for CFPB and other regulators to be involved. And that brings me to one of the most important points, I think, in our Lending for Success report. Critics of consumer regulation are quick to point to questions of access and choice. And as a country, we tend to defend our freedom to make our own choices, and that's great. But there are two interconnected cases where I believe the public interest is on the side of more regulation. One is when a product is simply unsafe. We saw this with the Chevy Corvair and the Ford Pinto decades ago, and we see it today in the financial marketplace. Later this morning, the CFPB is expected to release its long-awaited proposed rule on payday and auto title loans in Kansas City. And its own research found that 1 in 5 title loan borrowers lose the car to repossession. Now, to paraphrase then Professor Elizabeth Warren, if 1 in 5 toasters exploded, they wouldn't be on the market. But products like title loans are on the market, and in a state like Virginia, where I live, 19,000 cars are repossessed every year when borrowers can't keep up with the loan terms. And again, going back to the essential nature of vehicles in individuals' lives, that's something that could be quite destabilizing. And the second is when a product's harm extends beyond that buyer. And I think that's a trickier test for us to think about today. The mortgage market prior to the foreclosure crisis is a prime example. In 2005, 2006, you probably didn't know about your neighbor's mortgage. You probably didn't care. If he or she had an option arm or a picket payment or a balloon mortgage, it probably wasn't any of your business. And who knows, maybe you didn't really think about the type of mortgage your neighbor had at the time. But the minute that home fell into foreclosure, it affected your own home value and the tax base of your community. And all of a sudden, you do care about your neighbor's mortgage because it does affect you. In the subprime auto market, it's possible, but it's still uncertain, that we may see our neighbor's problem become our own. At a most basic level, if people need to rely on family and friends for transportation to get to work and live their lives, we'll see the economic effects of that. And if we see more Americans unable to get to work or to keep their jobs as a result, I think we'll probably see that too. So those are a few questions, maybe a few answers. I anticipate our panelists today will drill down further into a lot of these topics in a productive, perhaps provocative discussion. So I'd like to thank you, and with that, I'll turn it back over to Teddy, unless I can take a question or two if folks would like.
Yeah, go ahead. Let's take a few questions.
Sure.
I've got one.
Sure.
So, do you have any, specific, proposals that you all, are you and the Center for American Progress are advancing to enhance supervision and oversight?
Nothing specific yet. It's a market that we're still looking at and figuring out what are the right levers that we should be talking about. I think part of it really, as I said, comes back to having better data from the outset about borrower experiences and about what's going on in the market so that we can make better decisions.
I was wondering, to the last point you made, have you seen any data or just evaluated anecdotally the impact of people like losing their cars and then translating to not being able to maintain their job and maybe that impacting the housing market or something like that?
I haven't seen anything directly to date. I mean, there's clearly a lot of anecdotes or anecdata, if you will, that are out there. And clearly it's going to depend on location. I've heard it most poignant from folks in rural areas where it's, it's doctor's appointments that may be far away. It's just the distances involved can be so great, and the social supports may not always be there.
So you mentioned lack of access to data is one of the main sort of barriers. So is that something that you guys are working on, or do we see people looking to do more research and data to collect more information about what's going on? Or?
I know that there is desire to get more data about the market. I think the extent to which the CFPB is looking to supervise financing entities is part of that, and making sure that we have more data that's available for decision making. The specifics of that I can't really comment on. All right. Thanks, everyone.